Hello, this is Jack Miller at Gelt Financial. Hopefully you're having a great day. Already tongue twisted and I didn't begin the video, but we're powering through it. The topic of the day is note-on-note financing. We're getting more and more calls on this, and I thought I'd make this YouTube video and go into details because a lot of people don't know what note-on-note financing is. So I'm going to start at the basics and maybe give a couple tips along the way on buying notes. So note-on-note financing is very simply the financing of notes. Usually it's notes and mortgages. Just like real estate is sold on the open market and you could buy a piece of real estate, debt is commonly sold. It's more commonly sold in the corporate area, but banks from time to time sell debt as well as Fannie and Freddie, and all kinds of agencies sell their debt. And it could be good debt. It's common to sell it when there's problems with the debt. So now I'm making this, and it's December 2020. We're, I don't know, in the middle or the end of COVID, but there's a lot of distressed debt. So buying distressed debt is a big item. A lot of banks and institutions want to sell their debt, and the financing of that debt is really what we're going to talk about today, called note-on-note financing. So all that means is if Joe Smith agrees to buy a note from a bank, let's say the note has a face value of $100,000, he could pay $100,000, or he could pay $90,000 or $80,000, or sometimes more than $100,000. It's the financing of that. So if you think of a note-on-note financing, it's similar to what a mortgage is on a piece of real estate, but it's financing on a note. So why do people buy notes? Usually it's because they could buy them at discounts. So you may have a situation where Joe Smith buys a note for let's say it's a $100,000 note, and he buys it for $90,000. If he thinks the property is, let's say, worth $200,000, he got a good deal. He has $10,000 gain on that. Now, of course, some of the things you have to look for when you're doing note-on-note financing, it's not so simple to say he has a $10,000 gain, because if the interest rate is, let's say, a 4 or 5% rate, and it's a 30-year balloon, you know, the yield on that may not be high. So you need to really look at the details of that. But if that note is in, let's take another scenario, that note is delinquent and it's in foreclosure, and the borrower does not have cure periods, and he's buying that note for $90,000, the face value is $100,000, and let's say it has an 18% default, and the property is worth $200,000, then it may be a very good deal. So note-on-note financing is simply the financing of note or debts. It's commonly in mortgages or commercial mortgages, but sometimes it's in residential mortgages too. Gelt Financial does it, as well as some other specialty lenders do it. Some of the things you have to be aware of, it's very complex. And how it works is you have to, number one, agree with the seller of the note. They have to want to sell it, and you have to agree on a price. The price is determined. There's a lot of factors. It's the value of the real estate or collateral. It's the interest rate on it, if there's a default rate, if the property, if the loan can be cured or not, the length of time on it. All of these things factor into the IRR. And it takes a special sophisticated buyer to buy these. If you don't have the expertise, team up with someone who does have the expertise, because I've seen a lot of people get into a lot of trouble. Give you an example. Let's say it has a 4% interest. Let's say, I'm making up numbers to get to the point. Let's say it has a face value of $100,000, has a 4% rate, and let's say it's a 25 years left on it, and there's a cure on it. If the borrower is delinquent, and let's say you buy that note for $90,000 and the borrower is delinquent and can cure the note, you may have to stick with that note for 20 years if the borrower can cure it. So there's a lot of details. Really, the devil's always in the details. You also have to focus on, and I'm just going off the top of my head, I apologize, I'm not more prepared for this. I'm an idiot, but anyway, I just wanted to get this out. Some of the things you should focus on are what municipal liens are ahead of you. Usually real estate taxes, gas bill, water and sewer is ahead of the note. So you have to look at that, because you may think you're buying a good loan to value, but if they're 3 or 4 or 5 years delinquent on the real estate taxes, you have to take that into consideration. It's not only the real estate taxes, it's usually municipal lien. So you really should do an M&J or mortgage and judgment search to see what's ahead of you. Again, the devil's always in the details. I would look at the cure periods. If they're cure periods, that'll affect it. If there's a high or a low default rate, that'll affect it. If you buy a note and let's say the note rate is 4% or 4.5%, let's say it's a bank deal, and the bank has a 10% default rate, that's one thing. But if it's a state max default rate and the state max is 18 or 22, that's another thing. So these are some of the things you should look out for a self-understood condition of property and what can go wrong, what can happen. Remember, when you buy the note, you're stepping in the owner or the originator's shoes. So if there's lender liability issues, you have to deal with it. And go into this eyes wide open. I spoke to someone the other day. They were looking at buying a note, and they told me that they expected to have the property back in 60 days. I said, well, what about if the borrower puts up a defense, or if the borrower fights it, or the borrower files bankruptcy? And it didn't even enter this guy's mind that that was a possibility. So note-on-note financing is fantastic. There's a lot of money to be made buying debt, distressed debt. By the way, we buy it at Gelt Financial, and we finance it at Gelt Financial. But go in eyes wide open and be very, very careful. It could be treacherous, and a lot of people could lose a lot of money on it. By the way, when you do note-on-note financing, loan to value and leverage is a key issue. Depending on what note you're buying, what you're paying for it, what the value is the property, companies like Gelt Financial will consider lending you 100% or close to 100% of it. If the leverage is there, we'll do it as debt. We'll do it as JV equity. If you find good deals, we'll do it where you don't have to put in any money. Can make a lot of money at it, but be very careful on it. So that's my 2-3 minutes. I probably went over on note financing. Remember, the devil's in the details. Read every document of the mortgage and note that you're buying, because you have to know it, because a bunch of attorneys are going to fight you on it. I can almost guarantee that. So anyway, take care. Have a great day. I hope I didn't babble on too long. Remember, check us out at geltfinancial.com. If you have any questions, post them on this YouTube. Like the channel, and we'll try to post more. Take care and have a wonderful day.